Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is host Richard Benuli. Today is August 19th. We have today Tom Luongo and Ira Harris. Tom is an Austrian School economist and a former research chemist who contributes to Newsmax Media, and he's also the owner and publisher of Gold, Goats, and Guns newsletter. And Ira is independent trader, hedge fund manager, global macro consultant, trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and a stint most recently. Welcome, gentlemen.
Thank you, Richard.
It's great to be here, Richard, again.
Great. I thought we'd begin, Tom, with your global macro view on the economy and the financial markets.
Sure. Let's see. Well, given the state of geopolitics at this point, i.e. the war in Ukraine, the conflict in the Middle East, the growing de-dollarization trend, still very small. With the BRICS, I think what we're seeing now is a real, like, we're in a weird moment where everything could begin shifting. And I think that a lot of people who are bearish on the dollar are probably going to be very surprised going forward in the future. But as of right now, it's, we have just had things changing. The Fed is at the end of the latest tightening cycle. We don't know when that's going to end. We expect it's going to end in a couple of weeks. I'm not convinced of this for a variety of other reasons. And then we have the Bank of Japan now trying to tighten. And at the same time, I think all of Europe is trying to loosen. So, with all of those things happening all at the same time, it's almost like there's a very interesting kind of cross current happening here, where it's like the Fed and the BOJ on one side and Europe on the other side. Europe, the Bank of England, the ECB, the SNB, and others on the other side. And so now I think that's the big question that everybody has, is how that's going to affect, capital markets and everything else, because I think we're entering into a period where everybody wants to go back to the zero bound, but maybe not the Fed. Everybody wants to go back to the zero bound, or everybody would like the central banks to go back to the zero bound, but we really can't, because we're actually entering into a period of institutional breakdown where everybody's trust in the current institutional framework, politically, economically, socially, is breaking down. And that under those circumstances, bond yields should rise, gold should rise, hard assets should rise. So that's what that's where I think we are.
Do you see that change as being more of a secular long-term trend in terms of rising interest rates and rising inflation, perhaps?
I do. In that respect, I guess I agree with Martin Armstrong that that if we're entering into a period of conflict, whether it's actual open kinetic war between, Western and quote unquote Eastern powers, and I'm not convinced of that, by the way. But if we're entering into at least a period of conflict, then I don't see how we can square like lower interest rates and low oil prices with that. I just don't see that happening. What I see is a whole bunch of people putting their thumb on the scale through the manipulation of yield curves through central banks in order to try and affect that. But that's all that's doing, is putting up more and more people on the wrong side of the long-term trend. That's what I see. So,
yeah, interesting. And your thoughts, Ira?
Yeah, I think what Tom says is very true, and we are entering into how to understand this. We're definitely seeing changes, and I go back to saying, as I've talked about on several podcasts, that the change was taking place, especially if I go back to the podcast that Daniel Ikaye and I did in, I think, July 22nd, July 23rd, and how you could see that it was shifting, that the yen was definitely changing regardless. It was no longer about what the BOJ and worried about intervention, because the first 2-3 weeks of July, if you looked at any type of charts, and I'm not touting myself as a technician. I mean, I can read a chart, but that's not my strength. but you could see that there were fundamentals starting to change, and the fact that the yen was starting to move up in value using the IMF. If you use futures terms, you could see, and the dollar was moving down. It was due to some changes taking place because the bank was not intervening. We saw an intervention by the BOJ a couple of times, late April or early May, and then one time in June. But there was no intervention, and yet you could see some people who were short the yen because of the carry trade were starting to unwind it. And why? Because we saw the yen going higher, little bit by little bit by little bit. And it was only the complacency of those only trading interest rate differentials were they putting on that trade. But, and Tom's shaking his head, interest rate.
I agree. I did. I also, the only other thing is I did hear, Ira, that the BOJ did intervene on August 5th to a tune of about $39 billion. But I mean, that's what I heard. I'm not,
I will say this: we didn't see it though because it didn't show up during the Treasury market. So if that was the case, they didn't go to sell it, and that was those who were short and complacently short yen as they were doing the carry trade started to panic, and you could see it. And now we have the dollar in a situation. The dollar index, which I'm not a fan of following, by the way. I'm an IMM CME guy. I'll trade the futures. You have even the index itself, though, is starting to approach the 200-week moving average. And this is still, the differential is still wide. So there are other things going on. And we've seen interest rate differentials are not always a positive for a currency. And that's what I think the dollar right now looks like. Why? And we should be asking ourselves, and you could see it last week. The gold was also now starting to go with the dollar. And the gold started to rally last week, even with the dollar moving up a little bit. But then on Friday, we saw an interesting move downwards in the dollar, and gold really took off. So things are definitely changing. And as Tom talks about, we'll get to Europe. And this is with the euro, the dollar is going down and Europe is in no great shakes here. But yet the euro is approaching the 200-week moving average. I think it's just over about 110.80 or something.
Yeah, it was just about like 110 this morning. Yeah. Yeah,
we're getting there. So a lot of things are going on. There are definitely changes. What are they? Well, I guess we're going to have to talk about that but those who are just talking about the carry trade, I think they're missing quite a lot here because the dollar is going down, even though the interest rate differentials are sustaining themselves. And I'm really hard pressed to believe that a 15 basis point increase in Japanese yields on July 31st, that it could create that type of dynamic move in the next 4 or 5 days. I just don't believe. So other things are afoot, and we're going to have to start paying attention to those.
Yeah, and what I would just to add to that, Ira, is that when I look at I think there's something more. I think I'll be honest with you. I think there's something more sinister going on than that. When I look at the TIC report, right, the Treasury International Capital Report, and I've been talking about this for a couple of years now, and you break it down by region, right? It's very clear that Europe is buying unbelievably are they buying U.S. Treasuries. They're up since September of 2021. They're up almost $900 billion. The BOE now owns more treasuries than China does. Canada owns $300 billion. Ireland owns over $300 billion. There's there's $60 billion in the British Virgin Islands, which is never reported, by the way. On the MHF table, there's a reason for that, for the MFH table, the top 20, even though the British Virgin Islands is easily in the top 20 holders. Why is that? This has been going on for a while, and I think that what you're seeing is the effect of Yellen and Lagarde running yield curve control on the U.S. market in order to keep Germany and France and Italy and Spain from breaking out, and therefore, because of all of that, that's what we've been watching a yield curve control operation coordinated between Yellen and Lagarde and the BOE and the SNB and others for a while now. What's interesting is that the SNB was the first one to cut rates, right, back in April. And I said, when they did it, I said, oh, well, they're trying to prop the euro up, which they're doing a fine job of. Also note this morning that oil prices are, Brent crude is trading under $80 a barrel, and the euro and the yen both are up today versus the dollar. I think everybody's trying to manage their currencies a little higher in order to secure lower oil prices while oil prices are low. And then the minute oil prices start to break higher, we're going to see we're going to get the two for in the opposite direction. We're going to get rising oil prices and falling currencies, certainly falling euro. As far as the yen is concerned, I honestly think that this is coordinated policy between the Fed and the BOJ to bring the yen, to strengthen the yen, to allow to give Powell cover to not have to cut interest rates, because what the BOJ is doing is draining dollar liquidity from the world. Right? That's been the Fed's goal for the last 3 years, which is to drain the euro dollar markets and get domestic control over the Fed monetary policy and take it away from the euro dollar markets. With the LIBOR ending on September 30th, like, it's all coming together right here in this period of time, and everything is changing. And I've been waiting for the yen. I've been waiting for the Bank of Japan and the Ministry of Finance to make a big move, or at least signal to the market that they're going to make a big move, which would then start the process of unwinding the trade. I have a friend who trades Japan all the time. He's been saying this for a long time. He's like, watch Japan. They're going to defend themselves, and when they do, the market's not going to be prepared for it, and we're going to get ugly. And I think what we got the other day was a warning shot from the Bank of Japan. Begin unwinding the trade, folks, or you're all going to wake up tomorrow broke, because we're not going to sacrifice Japan for your trade anymore. That's what I think is going on.
I don't know if I could add. Tom,
sure, please.
So there's my son is an expert on Japanese politics.
Sure.
Very well. So he
Good.
put out a piece 3-4 weeks ago. Actually, I think Richard has it, in which he cited there were 6 candidates for the head of the LDP, even before Kishida
announced he's stepping down.
Decided he wasn't going to run. And actually, my son had talked about that Kishida was having a lot of problems. But more importantly, in mid-July, you started to hear from the potential heads of the LDP that they were citing the weakness in the yen as being a problem. We had not heard this whatsoever. And my son, Tobias Harris, not the basketball player, laid out that there were 6, and each one who was more either hawkish about needing the yen to be higher or more dovish. And once that became part of the political discussion, and it changed with people all of a sudden buying the yen. So some were starting to pay attention, going, there's a change here.
Yes. Well, what's interesting, Ira, that's perfect, because what I've also heard is that, and you think about it, is that with the interest rate differential the way it's been since the Fed raised rates, Japanese corporates have been parking all their money in their profits in U.S. treasuries. Now that money, but Japan wants that money repatriated. So how are they going to get it repatriated unless they strengthen the yen or raise interest rates, or both, which is what they're doing slowly but surely. And so the political signaling from the LDP towards a more hawkish yen is a clear signal to Toyota and Yamaha and Honda and everybody else. It's time to bring your money home, folks. We have a Japan that needs to be rebuilt. And we're going to strengthen the yen to get energy prices down domestically so that we can actually start this process. And that's, I think this is policy from Japan at every level.
I agree. If I may add one more thing, it's like This morning, and still Japan is cheap based on the weakness of the yen. And you see it this morning, right? The Canadian group is now buying 7-Eleven. No small thing. And if you're looking at the yen, if you think the yen is going higher, and you had any eyes at all on some Japanese corporations that you might want to buy into, looking like what Buffett did. And let's go back 2 years already with COVID, when Buffett bought into the big 5 corporate trade firms, and he's done unbelievably well with it. And that was when the yen was at this about level anyway. But if you're looking, and I think, I've been very, very bullish on Japanese banks, especially Sumitomo Trust, Sumitomo Mitsubishi, and I've been Tokyo Mitsubishi, because again, with the yen where it was, and the fact that, as you talk about, they're loaded with cash, and the cash has been parked elsewhere. But as we saw them back in, right, when the yen went to 75 to 80 to the dollar, when the world economies were all struggling, we were embarking on what Bernard Connolly called risk on, risk off.
Right.
Because we know the Japanese have so much money invested around the world that when they get a little bit nervous, or when they think that the yen is going to go higher, bring it on home. Right. I see her hand. They're bringing it home. And how far? We don't know, but it does. And you don't have to raise rates. If the yen is going higher, the Bank of Japan can be a little bit slower in raising rates. But that brings us to the dollar. Richard, I'm done, so I have nothing else to say.
Oh, I just wanted to ask, Tom, so do you see only U.S. Treasury bond buying by the G7 minus Japan, if you will? Like, is it limited?
It's across Europe. It's like everything that's across the Eurozone. And yes, it's primarily like the European part of it. I mean, like Australia is not. I put Australia actually in the Asia Pacific category. When I broke it down into the Eurozone, the rest of the world, and Asia Pacific. And Asia Pacific specifically is the big ones: China, Japan, Singapore, Taiwan, South Korea, and Australia. And the other ones don't really matter. They're all, I put those all in the rest of the world, like Malaysia and Thailand. They don't really matter, because that and that's been mild buying, and that's mostly just keeping the exchange rates tight. But Japan has been a very key part of this, and as China early on, as China sold, the Europeans were buying in order to keep the bond prices in the United States bid. Janet Yellen doesn't want the long end of the yield curve to rise, but neither does she want to issue 10-year bonds to fund the Treasury deficit. She's clearly, in my mind, the woman is a traitor as far as I'm concerned. She's clearly trying to destroy the fiscal position of the United States. I don't think Janet Yellen is stupid. I mean, I do think she's stupid, but I also think she's evil. And that's a bad combination. And so she's issuing 30-day, she's issuing 3-month Treasury bills, 6-month Treasury bills, and not issuing the 10-year bond to keep the interest, to keep the yield curve inversion as high as possible, and to keep the long end of the yield curve suppressed. This is the woman that ran both OT1 and OT2. Like, this is nothing new. This is Janet. Her middle name should be called yield curve control. Like, that's what she's always done, right?
Yeah.
So, what a shock that she's doing it at the Treasury, and she's trying to outlast Jerome Powell, hope that they can get to the other side of the election, then blackmail Powell with the last year and a half of this term to lower interest rates, and then fund a deficit that's completely out of control. That's their plan. That's Kamala Harris's plan. It's clear what they want to do. And on the other side of it, there's the Fed going, sorry, but until you get rid of me, you're going to pay 5.5% for your communism. Like, let's just be blunt about it. And so if you map it ideologically, all of this stuff, the political people who are driving the policy, and personnel is policy, then you can see how it's mirrored in the central banks. And then you have to simply ask the question of, does the Fed operate as an independent organization that wants to survive this, or does it want to be subsumed by the Treasury? And the same thing goes for the Bank of Japan. Same thing goes, and I think neither of them want that. Whereas the ECB is clearly trying to consolidate power and then crash Europe and then send everything up to the IMF, the BIS, and the UN. That's what they want to do. That's their plan. That's what they've talked about. So why would we be shocked that they would want that they actually implement that plan? And then why should we be shocked if the Fed and the guys on Wall Street go, you know what? No, we don't want that. So that's been my thesis for 3 years now as I watch this play out. And I just think that that's like when you start with personnel as policy, and then you start looking at how the capital markets and how they implement policy. I think the rest of it is downstream of that. So,
and further to Ira's interest to discuss and focus on the U.S. dollar, what are your thoughts there, short, medium, long term? What other additional factors that we haven't covered yet?
Are you talking to me, Richard?
Tom, yeah, for Tom.
Sorry. So what else? I'm sorry. What could you repeat the question? I thought you were talking about.
Yes. Just further to Ira's question on the U.S. dollar, what are your thoughts there in terms of the strength, weakness, short term, medium term, long term, and other additional factors we haven't covered.
In short term, I think we can have more dollar weakness, and I don't think the Fed's really upset by that at all. I don't think the Fed cares what the stock market is. I think the Fed is happy that the Dow is at 41 grand, so that means it's yet another excuse for Powell not to cut rates. I think that a weaker dollar. I think the dollar exchange rate between 102 and 106 is where everybody wants it. It's the dollar index above 106 that was where everybody starts to freak out. I think, and the dollar below 102 is where, honestly, it's where everybody starts to freak out for different reasons. Like a dollar that's too strong it means a euro and a pound that's too weak, or a euro that's too weak. The pound is way overvalued. And clearly the BOE is operating, is using that the ECB is using the England as a piggy bank to prop up the euro, because the euro should be trading at 90 cents. I'm sorry, I just don't buy it. And so everybody's kind of propping up, the house of cards that is the EU and is the ECB. And at some point, that's all going to collapse, and it's going to look darkest before the dawn. We're going to get a breakout to the upside on the euro, and then that's going to cause the collapse. That's going to cause the snapback trade in the opposite direction. You're going to get everybody on the wrong side of the trade, like we saw with the yen at 162, and then somebody's going to pull the plug on a trade, and the whole thing is going to start collapsing. Because at some point, they're going to run out of the ability to buy U.S. treasuries, especially if Trump comes to power and balances the budget. Then what?
Yeah. Well, interesting. Your thoughts, Ira?
Well, so we're getting to Europe. But looking at the dollar per se, and we're definitely in this range now between 102 and 106, although I think it's tightening, and I would say we're probably between 104 and a half and maybe 101 and a half. We'll see where we go this week. But interestingly, we know that in last week, Bloomberg wrote an article about, the carry trade is going to be put back on. Not so fast, because we see the yen going higher, and as Tom talks about, the euro going higher. The Swiss actually rallied back. The pound is at 130, but the peso has now settled in here, and it was a yen peso trade. But interestingly, we got the real, who's moved quite a bit, almost 10% in the last week and a half off the bottom. And even more interestingly, and this is what is really to me interesting about the dollar and why it's this time we're in a little different story, is even the South African rand is moving up quite a bit. So we got people buying high yielding. The South African rand is high yield, Brazil is high yield, the peso is high yield. And what was going on before, they were borrowing more. Now, I would probably say the Swiss franc is going to be more of a carry trade than the Japanese yen, right? Up to a point.
Possible, yeah. And especially if the Swiss keep cutting rates. I don't know that they will, but.
Well, we got Thomas Jordan talking tomorrow, and Thomas Jordan has retired as of September. So we have things that are going on here. And as you point out, the S&P is protecting the Swiss against the euro. What it does against everything else in the world, except for the yen. Because I maintain that when the Swiss yen made all-time highs, and it was for 3, 4, 5 months, the Japanese and the Swiss compete in a lot of export markets because they're in the pharmaceutical market, they're in the high-end engineered product market. So I think the Swiss were very aware of it, but they were smart because they had room. They took off $300 billion of their balance sheet, which was highly invested in global equities. But they went from 950 billion balance sheet down to 650. Now they're back up to about 730. So they have room, according to the way they like to trade, how they're going to do this anyway. Again, all these things are taking place, and I think Tom's point, and I hope we're going to get deep into this, Europe becomes very interesting.
Yeah, So it's interesting, Ira. So this just as you were talking, I wanted to make sure that I was up to date on this. I pulled up the Euro Swiss franc cross, and since the SMB started lowering rates, and there's two big downdrafts in that right after each of the meetings. But then every time after the meeting, it starts trying to snap back up again, and it turned, it hit a bottom and turned exactly on the same at the same time, or a couple of days before the yen broke out. Went crazy on that Thursday and Friday the week before, and then on Black Monday, between that time, the euro franc cross bottomed and started moving higher, and that started so we started to see a bit of an unwind there, because at some point when the Swiss have to stop protecting the euro, that's when the euro yen carry trade is going to unwind at an even faster rate than it's beginning to. And the euro yen crossed through a reversal signal 3-4 weeks ago as well.
You know what, Tom? And you bring up a great point. But that, if you look at it, it coordinated with when Kishida stopped in Berlin on his way home from the G7 in Washington. He stopped in Berlin to talk to Scholz. Right. What did they talk about? But the euro yen made its high around then.
Oh, that's a great point, Ira. I missed that. I've been so focused on so many other things. I missed that. Nice, good catch.
I have my son who really covers this stuff and sees the politics of it, and yet it didn't get a lot of play. But that high at 172, 173, which was, as to quote Jean-Claude Trichet, that's preposterous. Because and I say that for a reason. Back in 2002, 2003, when I was on the CME board, we still had the Deutschmark listed. Right. Now that drove, so Trichet was coming through Chicago and stopped, and I was lucky enough where I could sit in a room and talk to him. And I think the euro yen was like at 102, 103. I'm not looking at the chart. Right. And I asked him about that level, and he said, "That's preposterous." Yeah, then it was that the yen was too strong against the euro. So I just imagine it going the other way, because I think it's important, again, especially when it comes to Germany, because Germany and Japan compete in the high-end luxury auto market. So they were getting their asses kicked trying to compete with the Japanese, and the Japanese were far outperforming them. So interestingly, that when Kishida stopped in Berlin, all of a sudden things get a little bit, without an announcement. But I think we have more to talk about Europe, Richard. So
that's
where are you going to
interesting. I mean, further to Germany, what are your thoughts, Tom, on Germany's industrialization? Do you see any trends there? And also recent concern on the Nord Stream event. Is there potential for Germany to align more with the global South than the G7? What are your thoughts?
Well, I mean, let's not kid ourselves. Everybody has conspired to make sure that Germany doesn't conspire with the global South. I mean, what do you think? What do you think blowing up Nord Stream was all about, right? Okay. So hey, we're going to take away Germany's cheap Russian gas, which was how they were. I'll be honest with you. If you're Italy and you saw them take away, the Germans and the French take away all of their access to North African gas, the Italians are not crying over the loss of Nord Stream in any way, manner, shape, or form. I have friends over in Italy who are like, understand, this guy's Germany's working for Putin, and no, it's not that bad because they're Italians and they're histrionic. I wouldn't know anything about that, but being Italian, but no, it's not that bad. It's just that at the end of the day, they were looking to get, the Italians wanted their, wanted cheap gas. The Germans wanted cheap gas. And Nord Stream was always, from a European perspective, a political project to tighten Germany's control over gas supplies inside of Europe. And then therefore they can control the continent politically by, because then most of the gas would not be coming through Ukraine anymore. It'd be coming through Nord Stream 1 and 2, could be redistributed through the Opal pipeline. They could put the screws to Poland. They could put the screws to Hungary, yada, yada, yada. So that's what they were going to do. That's why they blocked South Stream and that had to be rerouted as Turk Stream. It's why. That's all the last 10 years of pipeline politics. So Germany has now been, the other side of that is that Germany has been, brought down. Now, to me, I'm going to get way away from currencies and all this other stuff and say, well, that makes sense, because at the end of the day, I still believe that this was a British and Polish operation, not a Ukrainian American operation, because it's the Brits who always like to play balance of power. So at the end of the day, you bring Germany down a little bit. That means you bring the EU down a little bit, but you bring Russia down at the same time. And everybody is brought low. If Britain can't win, everybody else will be brought low. Never, ever, ever forget that. And then they'll do everything imaginable through the intelligence agencies to obfuscate the fact that they were involved in any of this. They're very good at it. They've been doing it for 300 years. It's their superpower, folks. So, honestly, color revolutions and balance of power, it's like the one thing that the Brits are really good at. They're narcissistic abusers, and they like triangulating between people. Now, that being said, Germany's in a mess. Like, it's just that simple. And I think it's a mess that was designed politically and, geopolitically through the events of the conflicts that are existing outside of the capital markets. So again, personnel is policy. Nothing else. Nothing has changed. The interesting part about it is going to be that AfD is now running a campaign for the 3 states that are coming up. And Alice Weidel is in the Bundestag this morning, literally saying, Ukraine owes us reparations for blowing up Nord Stream. She's running on that. That just hit the wire yesterday. And I'm like, oh, golf clap. That's going to get you 3 points in the polls in Thuringia and Saxe and possibly Brandenburg. Because if AfD can push themselves into a superior position there, there's going to be no way to maintain the cordon sanitaire of them staying outside of state governments. And therefore, AfD gets to enter the Bundesrat, the German upper house, and start affecting policy. At the same time, the Greens may be kicked out of all of those governments because they may not poll 5% in any of them. And so that's the crux on Germany. That's these state elections that are coming up in the next 3 weeks are absolutely enormous. And believe me, everybody in Europe knows it. And so they're going to move heaven and earth to make sure that does not happen. But we'll see we'll see how they vote. They count the votes in Germany in 3 weeks.
Fascinating perspective. In your thoughts, Ira?
Oh boy, this is a discussion I've been waiting to have on this podcast because we never get to it. But Europe, to me, if you ask me, Europe is the most dangerous place in the world right now. And I'll tell you why. Because, as Tom brings up, Germany is a problem for the world because Germany guarantees the entire EU and the sovereign debt exposure. Right here, I go through these all the time, and when you look at interest rates on 10-year debt on all the different sovereign debts, if Germany said no more, we're not guaranteeing this anymore, you would go into a debt deflation because then the ECB wouldn't, unless they just kick the Germans out, but then the ECB then it becomes inflationary. But without that, you're going to have huge losses on sovereign debt around the world. You go into debt deflation. It's a very dangerous element. And I'm not being conspiratorial. This is the fact. And you understand that Lagarde back in, it was either April or May, on the day of the ECB meeting, what did she bring up out of nowhere was the Capital Markets Union. That's what she needs to do. Because as Bernard Connolly, who I mark as a friend, said from the day one, if you read his book, The Rotten Heart of Europe, what mistake did they make? They did this all backwards.
Yep.
The currency comes after fiscal harmonization and a euro bond, right?
Yes.
They talked about it during COVID when they issued a PEP bond that, quote unquote, I'm quoting the media, it was a Hamiltonian movement. But it really wasn't because they didn't issue enough debt in so-called PEP bonds. So you still have 19 different sovereign debts making up what exists in the ECB balance sheet. This is a real danger. And as Tom talks out, he's citing that. But overnight, I don't know if you saw this, Tom, Christian Lindner, who is the finance minister of Germany, said no more money to Ukraine because it was violating what we used to call the Schwarz now, which was the black zero, and because Germany does not want to go into deficit. So
Right.
we're not spending that $7.5 billion. This is major league. This is a big thing. And Macron is in no way, because he's blown himself apart anyway. He played a card, and now he's got to worry about the Germans. And as Tom talks about, the AFD. And now we haven't even gotten back to another. Again, this is not conspiratorial. These are all real things. And when the AFD came into being in 2013, the first thing they did was go to Karlsruhe and the German Constitutional Court to challenge, again, the Lisbon Treaty and the violation of what the ECB was doing to buy sovereign debt, to build that balance sheet. So there are serious, serious issues. How this plays out, I don't know. But I think, forget about cutting rates in Europe. Lagarde needs to get that capital market union in place, and she knows it, and which is why the ECB did put out a paper on a capital markets union. Now, why the media chooses not to discuss more of this is beyond me. But Europe is a real potential danger to the entire global financial system. Forget it. Carry trades, you ain't seen nothing yet, because if you get into a situation like we saw 2012 and 13, remember, Greek 10-year notes went to 40%. Italy was 7.5%, 8%. So that could easily reoccur. And who's there now? Because you got the U.S. debt situation, and you're not going to go running to the U.S. debt, because the exactly what Tom talks about with Yellen, that's a mess too.
It's a mess. No, it's a complete mess, because what she's done is she's restricted supply of the U.S. 10-year or the bonds so much that people who need collateral to shore up anything against a margin call, they have to run into the U.S. Treasury at 10-year 3.9%, which is insane. Now, interestingly enough, Tyra, I've been tracking on a daily basis the German-U.S. 10-year and 2-year spread for 3 years, waiting for the day when Lagarde loses control, and she's beginning to lose control again. There was a panic when the euro hit 96 cents, and then the BOJ came in and put the kibosh on that back then, and then the BOJ was put in place for a little while, but that's rolling off the board now. And now we're looking at the U.S. German 10-year spread of negative 160 versus negative 180 or negative 200. We're talking at the 2-year doing the same. I'm watching the same thing, and the 2 years generally leading the 10, and it's doing a stair step down out of the 160 range. And it starts getting down into Lagarde held it at like 180 for a year and a half, plus or minus like 10 basis points for a year and a half. And now it's at 160 and falling. So it's like everything else. Okay, so you want to cap German 10 years, but you can't by capping U.S. 10 years, but you've now pushed U.S. 10 years down so low, you've now destroyed the interest rate differential, which is blowing up people's interest rate. The FX swaps, which is causing other issues, which is still going to cause other issues. Like, the whole thing is like one big mess. And to Ira's points about them needing a capital markets union, none of those ECB bonds or European Commission bonds are trading. Have you looked at the prices on those shore bonds they traded in 2020? They issued in 2021. They're only like 40 to 50 cents on the dollar, and there's no volume. I mean, no one's bought them. So they sold hundreds of billions of dollars worth of these bonds, and now they want to sell another couple hundred billion to support Ukraine. Clearly to do exactly what Ira just talked about, capital markets union. I could see this. We could all see this coming. But they already stiffed everybody. They already screwed everybody the first time around. They sold 250 billion or 500 billion dollars of these things. They're all trading at 250 billion worth of, and at a par, like a half of par. Like, then no one's going to go back into that market again. You already burned all those people that you could raise that money from in the first place. So what are they going to do? Throw another 200? I mean, unless they just want to throw more, and they can do so if the U.S. was still at the zero bound. I believe firmly that if the U.S. was still at the zero bound, they'd just lever this stuff up and they'd buy the bonds and they wouldn't care. But the U.S. is at 5.5%, and Powell doesn't want to cut. And this is his way of tightening the vice on all of these people. And I don't think there's any love lost between Powell and Lagarde. He goes into the ECB. And 2 months ago, and he goes in and he goes, so, well, what do you think is going on during the Q&A? What do you think is happening? Or what are your inflation expectations? Well, we don't see inflation expectations in the United States getting down under our target of 2% until the end of 2026. He said this in the European Central Bank's house. Then there were at least 3 questions coming from members of the media who were never allowed to be there. So they were planted there by the Fed or by JP Morgan or by whomever to ask Lagarde questions she could not answer. So the US walked into the ECB, into their house, and put their genitalia on the table and said, deal with this.
Right.
It was the biggest, I mean, in central banker speak, it was the biggest flex of all time that I've seen in the 15 years I've been watching central bankers. Bigger than Draghi's, we will defend the euro and I'll do whatever it takes speech. Far bigger than that. This was Powell literally telling Lagarde, I own you. And that's it. And everybody missed it.
Meet the Cedar Owl, a new economics and finance publication with a focus on environmentalism. We combine the Austrian School of Economics and market environmentalism principles for investing in a sustainable future. Follow the link in the description to get to know the Cedar Owl better, understand our values, our mission, exactly where we're coming from, and the type of content that we release on a cyclical basis every Thursday. Join us in targeting outperforming portfolio returns while making a positive impact on society and the environment through technology. Subscribe now for weekly insights, investment articles, and exclusive content.
Wow. That's Ira.
No, it's just, and again, if we look at that target 2 and the way target 2 works in Europe,
yeah,
the Germans guarantee all of this.
I know.
And the politics in Germany are eroding so quickly. I mean, we have the so-called traffic light with the red, green, yellow coalition being the yellow. Now Lindner, who is from the Free Democrats, which is the most capitalist party and represents capitalism in Germany, taking this stance. It's almost like he wants to blow this up too, because that's a powerful stance that he took overnight with cutting off funds.
I mean, Ira, the FDP has destroyed itself being a member of this coalition. I mean, this is a party that, was polling as high as 12% a few years ago. And it's not going to, during the next Bundestag elections, it's not going to poll 5%.
No.
It's going to lose,
And in those 3 Eastern regions, you might get the AfD get 25 to 28% of the vote.
Try 30.
Yeah, 30. The Christian.
No, we're seeing 30 in Saxony and Thuringia. We're seeing 30 plus.
And from the left, we have what's her name, who's left
the PSW
named after her, is also polling those. So we have extremes building in Germany. That is not good, especially because the whole EU is dependent upon as I say, the German credit card. End of story. And if it fails, that will be the biggest story. Why nobody talks about it. But Lindner overnight, with this pulling the plug on granting funds to Ukraine, this is a whole new dynamic. And as Tom talked about, what else happened yesterday? So Europe is, through Germany, it's really, really a problem. And I know the big talk last week was who blew up those Nordstrom and Nordstrom 1 and 2, who blew them up, and now they're blaming some on the Poles, that they were all part and parcel in this with the Ukrainian. So a lot of people have some opinions, but Europe is a problem, but yet the euro keeps rallying.
Well, again, are people just getting the cash? Are they raising cash before are they just raising cash before the collapse? Because it just feels like something is going to break. And again, as the U.S. German 10-year closes, it's going to have effects on everything else. And I can see people just getting to cash and not knowing what to do. And, and if that's the case, it's telling me there's a liquidity crisis brewing somewhere. Because remember, the one thing we didn't talk about in all the yen carry trade stuff and is the effect on tech stocks, right? It's clear that the yen hit its peak weakness along with the peak in the Nasdaq and Nvidia and all that. And Nvidia starts to roll over. The yen starts to strengthen. Those carries start to unwind. So the most leveraged yen carry trades, and people who are long QQQ calls, or or levered straddled in QQQ calls or whatever, like that. And that's the insane part, right? And those started to unwind. And maybe that's all we've seen unwind so far. We haven't actually seen any of the real yen carry trade unwind. As I was writing my newsletter over the weekend, I was writing about this stuff, and I said, it took 35 years to build the yen carry trade to the size it is now. It's not going to be unwound in a weekend, no matter what Bloomberg says.
No,
it's just dumb.
Right. This is built up over time, and you could see it, especially because lo and behold, what currency has also started to firm at the same time is the yuan.
Yeah,
so
exactly.
These are so far more coordinated, and the action has been coordinated on both ways. But now is, as Bernard would say, the risk off, risk on. So is the risk coming off? Well, if the risk coming off, then we're going to cash. Yeah. And that changes the entire.
And that's why gold is trading at 25.50.
Yeah.
And headed much, much higher from here. And it's also why I don't believe that oil can survive, in this $79 range either. I just don't buy it. I think so. I can, if you want to look ahead a little bit from where we are currently, start handicapping the election. Does the Fed and the BOJ, are they coordinating policy here in order to get rid of Biden, Harris, Yellen, and all these, these rotten globalists, and then understanding that by strengthening the yen more than the yuan strengthens in response, that narrows the gap between the yuan and the yen and makes and is a bit of a fig leaf to China in that respect, because they compete as well. And China and Japan, there's no love lost between those two. So Japan brings the yen down by 10%, the yuan comes down by 2%. Relatively speak, or they both strengthen, but one strengthens far more than the other relative to each other. It's a win for China, and that's a nice way of saying to China, look, Trump's going to raise tariffs, but we're gonna lighten the load on you with currency exchanges, while at the same time giving you a little fiscal policy room by allowing you to raise strengthen the currency a little bit. So if you need to liquefy credit, your credit markets, which are collapsing, go right ahead and do so. This feels like the right thing to do here if you're trying to de-escalate tension between East and West behind the scenes as a kind of a second order effect of all this other stuff that we see in the headlines directly. That's kind of the way I've been reading it as well. As at least one of the things I've been thinking about, and maybe that's one of the secondary effects. So,
your thoughts, Ira, before?
I'm right there, and there's so many things just taking place. And for the Chinese, don't forget, commodity prices have come off quite a bit. And that's with the dollar weakening. But that's because we're into a big grain harvest. I can look at soybeans and beans are so cheap. But the Chinese, if the Chinese currency holds to rally, you can look for them to stockpile all kinds of, because commodity price, we have oil prices dropping. Boom. We have copper prices dropping. We have soybean prices on multi-year lows, because most of it they buy from Brazil. And don't forget let's come back to the Brazilian real. The real went up to 5.8. We're down to 5.4. It wouldn't be surprise me now with the dollar weakening here that we might not see soybean prices rise a little bit, because there's one thing the Chinese can never tolerate: shortage of food.
Right.
And believe me, this is not China of 1960s, of 1950s, 60s, and 70s. This is a China that cares foremost about being able to feed its population, and they have enough wealth that this is easily done. And right now, if you look at soybeans, and I'm not telling you to go out and buy soybeans. I'm not telling you that. But soybeans in terms of real, which the Chinese buy, the Brazilians, because of, I blame it on Peter Navarro. I'm not a Navarro fan, but when they put those tariffs on, one of the things they shut off American farmers, and all of a sudden Brazil became the designated
Yes.
provider, and
Yep.
and it cost the American farmers who were building up, who spent 40 years building up the ag market, which they had lost in the 50s when the United States stopped dealing with, because there was always that battle in the United States in the 40s and 50s.
Mm-hmm.
Who do we support? Do we support Taiwan, or do we support the People's Republic of China? Well, you know what? The American ag sector, outside of the John Birch Society, were big fans of feeding China, because
Right.
the United States has huge surpluses because so again, we're back into this situation. But I'm watching the Chinese, because they did this during the lows in during COVID in 2020, when because the yuan went higher, prices were dropping in commodities dramatically because everybody thought we were going into a deflation, maybe depression, and lo and behold, the Chinese bought everything. They bought copper, they bought oil, they stockpiled everything.
I love talking to you, Ira. You remind me of things that I've forgotten to look at, and that's exactly a point I had. It's perfect. Like, I've been sitting here going, I just expect commodity prices to rise from here simply because they're now at their new floors. What used to be the price ceilings, $4 copper, $2 aluminum, blah 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 blah, are now the price floors. We're back at $5 bushel wheat, $4 bushel corn, $3 bushel oats, soybeans between $8 and $10 a bushel. They're low, but I mean, and aluminum, copper, everything is at their lows, and we're going to have another round of inflation coming, no matter what we do here. So, yes, the Chinese are okay with having the yuan strengthen, because of course they're going to be buying on the cheap here. Lumber prices around the world are in the crapper. Everything is in that position. So, I've been waiting for the beginning of the next commodity super cycle. It's gonna probably come. Now you've given me a trigger for it, and the trigger for it is going to be when the yuan strengthens far enough that the Chinese say, okay, let's turn on the buying program, and they start buying everything in order to start stockpiling. But they sold a bunch of copper at $5 a pound. Now they're going to buy it all back at $4 a pound.
Yep.
Yeah. And just a final question, given this perspective and view, would that change if there's an escalation in the Ukraine conflict or the Middle East conflict? How would that or could that affect the financial markets?
Ooh, what I'll say is this. It's pretty obvious at this point that China is intimately involved now in what's going on in Israel, Gaza, in a way that they haven't been before. They're intervening in Iran because they have now big investments in Iran, in Iranian energy, and other things in Iran, in order to ensure that occurs. BRI terminates, for all intents and purposes, but its major east-west termination point is one of them is Iran, right? You've got the international north-south transport corridor going from St. Petersburg down to Mumbai. You've got BRI going from Shanghai over to Bandar Abbas, right? And so China is intimately involved in that. So I just don't think I think that there are forces in the world, and I've named them previously, who need a war to cover their default. We've talked about it earlier, that Europe, to a lesser extent the Brits, they want a destruction of, they want the war to cover their default. They want to have an excuse to cut certain people out of the financial markets so they can cause a default, and then they can bring in whatever they think they're going to bring in next. I don't think it's going to work. But they think that's what they want. And then we have other people working behind the scenes to manipulate, to set the table such that if you do that, you're still the ones who are going to lose. That's the way I've been reading all of these central bank moves and all of these trade moves. That's what I've been seeing. And the more I speak, the more Ira talk today, the more convinced I am of that, the way, that perspective is correct. Because Ira's like telling me stuff that I hadn't considered in that. And then those all things are just slotting in even to undergird that thesis, which is a good sign that there are smart people out there and cooler heads trying to push trying to get people to really run the incentives, which is, oh, by the way, it's to your advantage and to your incentive not to let the world crash and not to have the world go to world war as opposed to the other thing. So we'll see which side wins. That's my read.
Wow. And your final thoughts, Ira?
Well, I think Tom is really, and he ignited the spark to this conversation, because we have to look at Europe. And Europe, those are the ripples that will spread out now. Now, where does China fit in here? I don't know. That is, as much as I believe I've read history and I've read a lot, understanding how this plays out in Taiwan, where does, China is definitely, because China has made inroads into the quote unquote global South and has totally outmaneuvered the United States in the global South, because the Chinese have operated so dynamically. The United States, as the Chinese keep saying to the United States, every time the United States says, the rules-based global order, the Chinese counter with the statement, whose rules? And the Chinese have not been static. They've been going to, especially the global South. And, we know the Belt and Road Initiative, but, I go back in the 60s, and why do they belong there? One of the first things I read on China was by a professor when I was at the University of Illinois, George Yu, on the Tanzam Railroad. So the Chinese were building inroads as a non-aligned nation because they had already broken with the Soviets. So in the 60s, they've been building these, and now they're more, because now they have more money. Even though China is, has some difficult situations right now, they still have a lot of money. And they're pouring money into places, and they're catching the U.S. off guard. And again, the Chinese have one naval base in the world, Djibouti.
Mm-hmm.
Djibouti's on the Horn of Africa. There's a lot of stuff going on the Horn of Africa, and yet the Chinese haven't been doing anything to quell it. So there's all types of, high-risk areas in the world. We got Europe, there's more stuff going on in the Horn of Africa between Sudan and Ethiopia, and the Chinese are there. So how are they going to play this? Don't know. But as Tom talks about, they've made inroads into Iran because they wanted to secure energy sources. The Russian situation, we don't know the way that plays out. But the Chinese are certainly here. I'm going to watch the yuan very closely, because that'll tell me really what they want. Everybody was worried about them depreciating the yuan, but I'm in the Michael Pettis camp, and I think Pettis has had this right more than anybody. No, because they need the Chinese middle class to begin consumption. Yes. And you don't become a consumption-oriented economy with a depreciated currency, because you're making your middle class poorer. Mm-hmm. And I think that's what we saw in Japan, because and I have the 6 up here, by the way. What did so more hawkish was Motegi and Ishiba, and Kishida was in the middle, but he's gone, and Kono Taro. So they know that the weak yen was wreaking havoc. This is not Japan of the 70s and 80s.
Right.
It's a whole different world. And this is Japan. Yes, they've done well because they have savings invested all over the world. And they've done well, and they've countered it. That's why when people talk about, the Japanese have huge deficits, it's different than the United States deficit, by the way. And theirs hasn't really grown in quite a while because interest rates have been low. So the cost of carrying that, and the Japanese also did something that the Swiss did. They did QQE. They did quantitative and qualitative easing. So they were busy buying ETFs and REITs. So the BOJ has actually made a lot of money, especially we'll see if the Nikkei holds in there. I think this is a very important time for the Nikkei, because it's not going to be like 1989, 1990. Although the funny thing is, when you go back and look at this, Tom, when the all-time high prior to the recent high made in 1990, the yen was at the same place. Dollar yen was 160 to the dollar. Now that's an amazing thing.
Yeah.
So here we are, but things are definitely shifting. Where they're going to hold, don't know. And I still say the Fed could cut, and I'll end with this, because in a world that is built on so much leverage, and I think this is what Tom alludes to with Yellen and Powell, there's so much leverage in the system that they created, by the way, or are responsible for.
Sure.
And you can't have R* or real yields at historically levels. So if the real yield over 40 years has been 2.2%, and I'm measuring it inflation to overnight interest rates,
right?
And we're in there now, and I think that's why that's so dangerous. That Powell could have cut rates and taken out an insurance policy because the real yields, based on the leverage of the system, are way too high.
So maybe he will cut by 25 basis points. I think the market wants it. Maybe, I think if he cuts 25, the question is going to be, and again, and the Democrats want him to cut 25. This is the final point, but they're dumb because when Powell cuts, the stock markets are going to drop.
Well, and I'll bring in
if he admits finally that the economy has rolled over, everybody's going to start. We're going to start seeing capital markets, the stock markets drop. I actually think that I can see Powell cutting by 25 when the market wants 50 or 75. I can see that, and that's still a very hawkish move on his part. He gets to have his cake and eat it too, especially if Ueda between now and then does something at the BOJ to signal that they're going to raise rates again, or they're going to do something else, right? And interestingly, the Jackson Hole opened today, and the big promotional picture I saw was Lagarde on one side, Powell on the other, and Ueda between them. I wonder. So, and it wasn't just to balance the photo because Ueda is short. It was very clear what the message was. We're going to fight over you. So, yeah, I mean, it's an interesting moment in time, and yeah, we'll see. I don't know. It's going to be fascinating. But I would bet on people moving into tangible assets during a time of political and geopolitical unrest in general. Where, in what order the money goes into: commodities first before gold, or gold before commodities, before this, before that, before stocks. I don't know. But it's all going to depend on the structure of where people they're going to be allowed to put their money, and that's so very important here as well. Yeah. Right.
Exactly.
So.
Yeah. Wanted to speak.
Let me just finish with this, because this is important to me. The Fed always cries that it's apolitical, but I'm going to raise this point, and it's interesting because the media is so damn lazy. God forbid they should actually go investigate something. The Biden nominees as governors to the Fed, more than a few of them have ties to Kamala Harris's father, who was an economics professor at Stanford and Berkeley. So that is no small thing.
No, it's not.
I can't believe nobody's written about this.
I missed it as well, Ira, but now that you bring it up, it's very obvious.
Go look it up. I mean, sure. Lisa Cook, Kamala Harris's father. I believe that Kugler has some ties to him. So,
and Raskin.
So we see where they come from. You don't get nominated to the Fed. It's not by your ability. It's, again, what is your ties and who's your sponsor, so to speak. So it's worth looking at. So I'll end there.
Well, it makes perfect sense because, again, they were put in there because of the insider trading scandal that was supposed to get Powell. It got Cap Fried and Rosengren, and then they couldn't get Powell, so they put a whole bunch of commies on board. And now all of a sudden, Chief Commie, quarter black Jesus, is running for president as a Democrat. What a shock! It's almost like it was scripted that way.
But all four of them are labor economists, and labor economists have a history of being dovish. Why they keep voting with Powell is another thing that boggles my mind. How is he able to get a unanimous vote? I have no idea. But it's interesting.
It's a good question to ask Danielle DiMartino Booth. She might know.
Yes, right? Yeah, I agree.
So,
Richard, yeah. That's it for me.
Yeah, well,
sounds good. Sounds good. Sounds like a wrap, guys.
Fascinating discussion. Just quickly, how can our listeners and viewers learn more about your work, Tom?
Oh, sure. You can go to my blog over goldgoatsandguns.com. You can follow me on Twitter at TFL1728. And you can sign up for Patreon, the Patreon/goldgoatsandguns, which is where most of the content goes. And of course, I also write Ultimate Wealth Report every month for Newsmax and contribute to Financial Intelligence Report as well. So that's my gig. It's my resume.
Great. And Ira?
Just, you find me here. You find me a few other places doing podcasts. I haven't been writing, but I am, I like, here, I get to sit and talk to people like Tom. How good is this? And we get to cover things in depth, Richard, and you handle it. So, it's amazing to me that the media doesn't find its way to these podcasts. Honestly, they always go to the same sources who were blindsided by, again, the carry trade. But we've been talking about the carry trade on this site for months and months already, and the potential for it to unwind. So if they weren't so lazy, they could actually learn something, and it's worth a discussion here to pick up whether you agree. You don't have to agree with it, but in the world of finance, you need to think. And if you disagree with it, know why you disagree with it, and how is that going to plug you this way. Richard, I just got a new, I'm sending it to you right now. I don't have Tom's email. I sent it. My son just put out a new piece. He's just back from vacation. So you could send it on to Tom. I'm sending it to you right now.
On Japan. Yeah.
No problem.
It's on Japan.
Right.
Yeah,
okay.
It's on Kishida. Oh, the Tom. So he's going through. It's actually pretty good. I would tell you, Tom, if Richard sent it to you, subscribe to it. It's worth. He's really good in covering Japanese politics, and I think
that'd be great.
Yeah.
Is now, as you point out, at the forefront.
Yeah. No.
Great.
Absolutely. Thank you.
Thank you so much, Tom and Ira.
Thanks, Tom.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.